And we are live with another episode of the Einstein Retirement Daily, where we curate financial, economic, and market news for the headlines that affect today's retirees. Today's topics, we'll talk about tax audit risk, some inflation distrust. We see people not really trusting some of the things we're hearing about inflation, and then volatility scares that are, let's say, putting people's retirement hopes in jeopardy. All of this coming up. As a disclosure and by way of making sure that you always make sure to take this podcast in its proper context, please do not view anything that we talk about today as specific tax, legal, or investment advice. If you get a wonderful idea from this podcast that makes you want to take some action, please consult with a qualified tax, legal, or investment professional who knows your specific situation and can help you make the decision that's right for you. Okay, Jeff Cox from CNBC. If you go to CNBC on their economy page, gosh, it's all about inflation right now, but Jeff Cox had a particular article where he highlighted that the Federal Reserve has no thoughts to change their policies related to inflation. So on the one hand, you have a lot of news reports, a lot of things coming out from multiple sources, multiple articles, talking about how inflation is up, prices are up. By the way, prices are just an indication of inflation. Inflation is the increase in the money supply. So inflation has in fact been here, but it hasn't been experienced in prices until recently. And so we're seeing price movement go up to reflect the inflation that already exists. So Jeff Cox, in his article, he did review an interview with Bostic from the Federal Reserve. And the Bostic says that the Fed is committing to maintaining low interest rates and continued inflationary behavior. So the rationale for this, if you're going, well, wait a second, so we're seeing inflation go up, but the Fed says they're going to keep doing this. You know, I would possibly encourage you, if you are somewhat economically minded, to consider taking a look at The Deficit Myth by Stephanie Kelton. We'll post the link in the comments section to her book. I don't really agree with modern monetary theory, but her book is a good review of what modern monetary theory purports, and it is the theory by which the Federal Reserve appears to be operating. So if you follow modern monetary theory, and this is something that you know about, none of this should be surprising to you. So the rationale with the Fed is that they are going to keep interest rates low in order to continue to push for more jobs. So joblessness means that there's not enough inflation in the system, there's not enough money supply, and so joblessness is solved by the Fed by reducing interest rates. Now, if you've listened to some of our shows in the past, you will know that when we look at how the Fed increases money supply, they do it through debt. So they are going to increase the debt load through low interest rates to try to eliminate unemployment. So although unemployment is on the decline, it's still about double what it was a year, well now 2 years ago. And so until we get joblessness down, the Fed is going to hold to this idea of keeping interest rates low. The other thing with modern monetary theory is that it will try to tax away inflation. So there's two ways to get rid of inflation. One is an increase in the interest rates. The other one is to tax it away. Because remember, inflation is just the increase in the money supply. So if we increase the money supply, how do you take the money supply back down? Well, you can tax it away, or you can increase interest rates and reduce the increase in money supply. There's this idea of sort of finding this kumbaya between interest rates and taxes that will lead to this magical steady inflation rate of 2.5%. So this all sounds wonderful in theory, and Stephanie Kelton, the author of The Deficit Myth. I believe she's a PhD. I want to say from Kansas or something like that. Like many academics, there's a theory and then there's reality. And I think a lot of these modern monetary theory folks who are largely in academia and then get brought into their work in the political landscape, they often love their theories maybe a little more than reality substantiates. And I would certainly think that. However, the book is very good in explaining what they're presupposing, and if you understand what modern monetary theory presupposes, you can predict a little bit about what things like the Federal Reserve are going to do. Okay, so the key takeaway is that there's a lot of distrust about inflation because on the one hand, you have the Federal Reserve, which is tied to the government in most fashions, saying, don't worry, inflation's not a big deal. This is temporary. It's not going to last. And then on the other hand, we see the prices going up. We see our grocery bills go up. We see the price of gas and the gasoline go up. So we're experiencing the actual price increases that are a reflection of the inflation that we know exists. But the Fed is telling us that inflation isn't big enough yet and it's no big deal. So a lot of distrust leads to a lot of uncertainty, and folks are certainly reacting to that. Megan Haney from Fox Business, I think I've brought her up again. She writes some nice articles, and she wrote about your tax audit risk. Now, if you don't already know, your tax audit risk is probably low in general, unless you happen to be one of those folks who has a more complicated tax return. Generally speaking, your average regular worker, someone with W-2 income, and really that's it, nothing too complicated going on, your audit risk is always very low. But she does highlight that the number of audits went down last year and is expected to go down again this year. This is because of a lot of the complex last-minute changes to the tax code, which is leading to an overburdened IRS. And so it's made it very difficult for the IRS to do its normal, regular number of tax audits. If you have a complicated tax return, don't assume that your risk is low, though. This is largely triggered by when you take lots of extra deductions. So if you take a lot of extra deductions, your audit risk is going to go up. Okay, you can pretty much bank on that. Now, whether you get audited or not, still probably pretty low, but do be mindful that the more complicated your tax return, the more deductions that you take, the higher your audit risk. Okay, stock market volatility is up. I think you have noticed that over the last 2 years. If we compare stock market volatility as measured by the VIX, okay, so the VIX measures stock market volatility based on the S&P 500. The S&P 500 has been pretty volatile over the last 12 months, maybe we should say 16 months. So going back to 2018, 2019, our average volatility today of the VIX is still substantially higher than it was in 2018, 2019. Compared to last year, it's way down. So overall stock market volatility is coming down, and we're seeing that. We're seeing the volatility of prices start to come down of late. However, we're still much higher than 2018, 2019 numbers. And so naturally, because that is close enough to remember, people are still feeling very nervous about overall stock price volatility. I would say that the other reason why you may not experience that volatility is down is because while the overall market in terms of stocks, generally the price volatility is lower, if you pick out any single sector of the market, you're not going to necessarily see it like that. So the sector look at the overall market is going to cause you to see still pretty high volatility. So when tech's cruising up, maybe other sectors of the economy are not doing as well, vice versa. And so while the S&P, which is more of a broad base, is much more smooth, any single sector of the market probably has more volatility than the total market as a big picture view. So people are still very nervous, understandably so. Wall Street Journal staff wrote an article that highlighted several things related to the overall markets, one of which is retirement insecurity. So they're noting that a lot of folks who are thinking about retiring or have just recently retired are very insecure about their retirement decisions. Very understandable. Okay. Reason number one, the future of taxes. So I retired planning on on paying, let's say, an average tax rate of 15% over the course of my retirement. But with some of these tax law changes that are coming in, maybe that will actually be more like 20 or 25%. Is that going to affect my savings? Absolutely. Will that, I'll still make it so that I can be retired? Unsure. Okay, so it depends on your individual circumstance, how much you've saved, and what sort of tax optimization decisions you're putting into play. But the future of taxes does not look very good, does not look favorable to a retiree, and so people are certainly nervous because of that. Overall stock market volatility, spending your dollars when the stocks there are investments that you have could be losing dollars. That becomes a very nerve-wracking situation. And then uncertainty about inflation. So if inflation kicks up, and instead of needing to spend, say, $60,000 a year, by next year I have to spend $70,000. By the following year I have to spend as much as $80,000. Inflation could cause me to eat away at my savings much quicker than expected. So the combination of inflation being high, the future of taxes, and overall stock market volatility is creating a lot of insecurity for folks. And so the Wall Street Journal is noting that in their article. Okay, all articles are linked in the description section of YouTube, so check those out. If you're not already familiar with our workshops, we invite you to check them out. We would invite you to subscribe to this YouTube channel here. Follow our Facebook page. If you're looking to sign up for an event, simply send us a message through our Facebook page at Einstein Retirement Workshops. We'd love to interact with you and engage with you there. And that's all we have today. We'll see you next time.